Okay, everyone, we're back for Chapter 8, Part 2, where we're going to continue talking about inventory. Now we'll be focusing on the removal of inventory. So, what we are looking at is how we, in the real world, actually determine the cost of inventory as it is sold. So remember, in the United States currently, everything, a particular item like a coffee cup, say, has one barcode on it, and it's the same barcode for that same style coffee cup. So no matter which coffee cup you sell, it will register in the computer that a coffee cup was sold and how much you charged for it. So you know you sold a coffee cup and which type of coffee cup you sold, but you don't know how much that specific coffee cup that you sold cost you. So if you have purchases of coffee cups that the price increases or decreases in your inventory, you have to decide, well, which coffee cup do we think we sold? And because we don't have the technology yet to say the coffee cup we just sold cost us $3, that specific coffee cup. We know we sold a coffee cup. We know the range of costs that are in inventory, but we can't identify a specific item at this point. So we're allowed to choose from 4 different methods on how we remove inventory. So what we're going to do is illustrate each one of those. You've already seen them in Accounting 111, but we're going to review them and make sure we understand them. For a perpetual system, and I believe we go through the periodic system as well. So the removal of inventory and choosing one of these methods could be done for both inventory systems. So we have the Browning Company inventory information for 2021 is as follows. So let's just give this inventory a name. Let's just say it's toilet paper. Okay, so on January 1, Browning Company starts with 4,000 toilet paper rolls. Let's find something even easier. Let's just make it coffee cups or cups. 4,000 cups. Each cup costs $5.50. Okay, so that's where they started their inventory with. During the month, they bought more cups. They bought 1,000 on January 17th. These now cost $6. See, the cost to them is starting to rise, and that's normal. March 22nd, they bought 3,000 more cups. They now cost $7 each. And then October 15th, they bought 3,000 cups that cost $7.50. So they bought a total and started the beginning of the year with 11,000 in total. So how many coffee cups did they have the ability to sell? 11,000. How much did those 11,000 coffee cups cost them? $71,500. Now on the bottom are the sales that were made of the cups. So on January 10th, 2,000 cups were sold. On April 15th, 1,500 cups were sold. And on November 20th, 3,000 cups were sold. So of the 11,000 that could have been sold, 6,500 were actually sold. Now, we can't just put in a journal entry 6,500 cups were sold. You know, we have to come up with a dollar value, a cost of those inventory items. So we're going to be looking at that. So here's what I was just talking about. 4,000 units started at the beginning of the year, 4,000 cups, 7,000 were purchased during the year. 4,500 are still on hand at the end of the year. 6,500 were sold. So that's the only 2 legitimate things that could happen with the 11,000 cups. They're either sold or they're still here. So the amount that are still here, ending inventory, plus the amount that were sold will always equal everything we could have sold. So you could figure out how many you sold, knowing how much are still left. You can know how much is left by how many you sold, so you can use that formula to do different computations you may need. So we know the units, but yikes, how do we allocate how much those 4,500 units that we sold actually cost us? Or or I'm sorry, 4,500 units that are still here, the 4,500 cups, how much did they cost? How do we calculate the dollar value of the cups that we sold? And that's what we're going to focus on now, because it's costs that we could put in our accounting records. The first method is probably the best method that you can use, but not many companies can use it. It's called specific identification. And this is used by companies that don't have large volume inventory. They may have high valued inventory, but not a lot of it. For instance, like a jeweler or certain type of car companies. So not every company can use this. What is it? Well, these types of companies can track how much the item they just sold actually cost them, because there's not a lot of inventory. So if they sell a gold bracelet, maybe they only have 10 gold bracelets in inventory. So they can identify how much that exact gold bracelet cost. So when they remove inventory, they could say that gold bracelet cost $2,000. You could see here the example given. You can track costs of automobiles by their VIN or serial numbers. So then when you sell an automobile, you can take it out of inventory at what that particular automobile cost. So companies who have low volume inventory, so low quantity, high priced, can use that method. And that's the best method, because now you're truly matching the sale price that you charge for that item with the cost of that item. But that's not how most companies work. Think of Walmarts of the world. Think of the paper towels they sell, or toilet paper, or high volume items. How do they determine how much a roll of toilet paper that they just sold costs them? They sell so much of it, and they can't track. They can't say that roll of toilet paper that we just sold, that particular one, cost us this much, because they don't have that technology yet. So for these types of companies, they're given a choice. They can average costs together, and each time they sell an inventory item, remove it at its average cost. They can assume the first items in inventory are the first ones sold. First in, first out. Now it's an assumption. It doesn't mean that's how they actually sell it. Okay, so we're assuming that's how that the items are being sold, so that's why we remove them that way. And then they have last in, first out, where the assumption is the newest items in inventory are sold first. We're not saying that's how they have to be sold. We're okay to assume that, to remove it. So you pick one of these methods if you don't use specific identification. So we're going to take a look at each of these methods, whether you're using a periodic system or a perpetual. So let's start with the periodic system. The periodic system, remember, we're not removing the inventory as we sell it. We're waiting till the end of the period. We're trying to find out what are all the items we could have sold. So we calculate the number of units in beginning inventory. We add all the purchase quantity for the year. So like with our coffee cup example, we could have sold 11,000 coffee cups. Well, how many are still left? And it's the 4,500. And those items are known. So we could subtract the 4,500 that are still here from the 11,000 and determine 6,500 were sold. So we need to figure out the cost of those 6,500 and make that end of year journal entry. Under the weighted average method, we say how much did our inventory, all the stuff we could have sold for the entire year, cost us? Well, the beginning inventory cost is $22,000, and all the purchases during the year, and that's net purchases plus freight in, so you know, was $49,500. So if we sold everything, our cost of goods sold would have been $71,500. But we didn't sell everything. We sold 6,500 of the 11,000. So under the average cost method, we say, okay, well, how much did everything cost us? 71,500. How many units were in inventory that we could have sold? 11,000. And we divide the 11,000 units into the total cost of everything we could have sold. $6.50 per cup. So we averaged it and said, okay, we're just going to remove our inventory at an average cost, $6.50 each. So you could see up there, when we're calculating, because in the periodic inventory system, we have to calculate how much should be debited to cost of goods sold at the end of the year in one big journal entry, dollar amount. 6,500 units were sold times $6.50 each. So cost of goods sold for the year would be $42,250. We do the same with the ending inventory. There's 45 cups left. They have an average cost of $6.50 each. So our ending inventory value at the end of the year, $29,250. So when we're doing our journal entry for the periodic system, we would debit inventory. So you could write this down if you're following me. Debit inventory, $29,250. Credit inventory, $22,000. Credit purchases, $49,500. And debit cost of goods sold, $42,250. So this is how we find the dollar values for that journal entry. We only determine the average cost in the periodic system at the end of the period once by that calculation. Under the perpetual system, now we're in a different inventory system. In the perpetual inventory system, we are removing inventory as we sell it. We're still going to remove it at its average cost, but we determine average cost differently when it's the perpetual system. And what we do is every time we add more inventory at each purchase, we recalculate an average unit cost. So let's take a look. Using that information from the illustration, this company started with 4,000 cups in inventory. And if you look, this is what we call a perpetual inventory record. Because we remove inventory as we sell it, we have to track it, each purchase and each sale as they occur. So this company starts with 4,000 cups at $5.50 each. That's their average cost, or $22,000 in total. So we have a purchase column there. Then we have a sold column, and then we always keep track of the balance after each purchase or sale. When they sell 2,000 cups on January 10th, which would be the next date in those transactions, 2,000 will be debit at $5.50 each are removed. So cost of goods sold would be debited 11,000, credit inventory 11,000 for that sale, because you have to remove the inventory the day you sell it. What's left? 2,000 cups that cost $5.50 on average. Now watch what happens when you purchase more inventory. On the 17th, 1,000 more cups were purchased. These cost $6 each for a total cost of $6,000. So we must calculate a new average cost per unit. We don't go $5.50 plus $6 divided by 2. No. We determine it based on total cost of all the inventory and total quantity after that purchase. So before the purchase, the total inventory in our balance was 11,000 cost. We just added 6,000 more of total cost by this purchase. So the total cost of all the inventory after this purchase is $17,000. We then divide it by the total quantity after the purchase. 2,000 cups before plus 1,000 more, 3,000. Carry it out 3 decimal places. Cost is 17,000 divided by 3,000 units. The new average cost per unit is 5.667. On the next purchase date, March 22nd, so remember we do this calculation after each purchase, 3,000 more were purchased. So we're going to add the total cost of those 3,000 to our existing inventory total cost. So on January 17th, we had 17,000 in total cost. We just added $21,000 in cost due to this purchase. So the cost of all of our inventory as of March 22nd is 38,000. The total quantity will be 6,000. There were 3,000 before this purchase. We just added 3,000 more. So we'll divide that 38,000 by 6,000 units. And we get an average cost of 6.333. And there it is. The average cost is now at 6.333. When we sell 1,500 of those, we will remove them at 6.333 or $9,500 in total. Of the 6,000 units that were in inventory, we just sold 1,500. So there's 4,500 left that have an average cost of 6.333 or a total cost of 28,500. On the 15th, when we purchase 3,000 more at $750 each for a total cost of 22,500, update the average cost per unit. Before the purchase, total cost was 28,500. This purchase added another 22,500 of cost. So now the total cost of all your inventory at this point is 51,000. There were 4,500 cups before the purchase. You just added 3,000 more. So now there's 7,500 cups. So divide 51,000 total cost divided by new total quantity of 7,500. Each one costs $6.80 each. Our final sale, where we sell 3,000 of the cups, they will be removed at the new average cost of $6.80 each, or $20,400. So in that journal entry, we would be debiting cost of goods sold and crediting inventory for $20,400. 7,500 were the number of units before the sale. We sold 3,000, so there's 4,500 left with an average cost of $6.80. So our ending inventory after these purchases and sales using average cost would be $30,600. Cost of goods sold, I can't go back to the prior slide, but it would be the cost of goods sold amount from the sale we had, I think it was in February, plus the 9,500 cost of goods sold from the April 15th, and then the November 20th cost of goods sold of $20,400. So that would be the total balance in your account, cost of goods sold, and you would have made the journal entries for those amounts each time you made the sale. Starbucks uses this method. Perpetual, average cost. What if instead the company decided we want to use the assumption the oldest goods are sold first, first in, first out? Remember, you're assuming or pretending this is how things are actually sold. They don't have to be sold this way. There's no FIFO police or LIFO police or anything else. You can do this, even if you know the newest items are sold first. Okay, it's no big deal. You pick the method you want to use. So we assume the first units acquired are sold first. Now, the first method we're looking at here is FIFO if you were using the periodic system. Remember, the periodic system, you're waiting till the end of the year to determine how much stuff is still here, how much is sold. And it's at the end of the year then you will determine the cost of goods sold. So what we do under the periodic system is we keep track of beginning inventory plus each sale by the date, or I'm sorry, each purchase by the date it is purchased. Okay, so the first purchase, what are they doing here? Okay, the first purchase was made the 17th. then the 17th, then the 22nd, and then the 15th. Okay, so that's what we do first. Now, first in, first out says this. How many items were sold? 6,500. Then the items in the oldest items will be used to calculate cost of goods sold. Since they sold 6,500, we remove, or the assumption is, the items in beginning inventory are sold first. So these 4,000 are removed. That cost $550. The next 1,000 are removed at their cost of $6. Now you need to remove a total of 6,500. So the next purchase was 3,000 units, but you're not going to remove all 3,000 units because you didn't sell 8,000 units. You sold 6,500. So you're going to remove 1,500 of that purchase, $7. So what we're doing here is removing the oldest inventory where we know 6,500 were sold. So we look to our units by the purchases and we go, okay, these 4,000 are sold, then 1,000, then 1,500. What's left? 4,500 units. So 1,500 of the purchase on the 22nd at $7, those are assumed to still be in inventory. And then the 3,000 that were purchased on October 15th, that cost $750 each. So to calculate cost of goods sold under the periodic system, that's the method we would use. List all your purchases and your beginning inventory, and then separate them between sold and remaining. And the way you separate them is you say, oldest stuff is sold first. Remove the oldest to newest. So in this journal entry, at the end of the year, remember one journal entry, we would be debiting inventory, 33,000, crediting inventory, 22,000. We would be, I forget how much the purchase amount was. Let me look at it really quick. We would be crediting the purchase amount, 49,500, debiting cost of goods sold, 38,500. And that should all jive out together. Okay? First in, first out under perpetual is a little different because we're removing it as we're selling it. So we have to keep track of purchases and sales as they occur, just like we did for the weighted average when you're under perpetual system. But we're still using the same assumption. The oldest inventory at a sale is removed first. So 4,000 units is where we start the beginning of the year. That says it's in purchases, but it shouldn't be. It should just be in a balance column. On January 10th, we sold 2,000 of those. So we're going to remove 2,000 at $550 each because the oldest inventory cost $550 each. What's left? 2,000 of those 4,000 that cost $550 each. In a perpetual system, we need to keep track of oldest to newest. So whenever we buy more inventory, we're going to populate it in the purchase column. 1,000 were purchased that cost $6 each. But then we're going to layer our inventory balance from oldest items to newest. So we're going to rewrite that we had 2,000 that cost $550 each, and now we'll add the 1,000 that cost $6 each. We do the same thing with the March 22nd purchase. In the purchase column, we're going to show that we bought 3,000 at $7 each. Then we'll, in our inventory balance, rewrite our prior inventory balance before the purchase, 2,000 at $550, 1,000 at $6, and now we just added 3,000 at $7. So that inventory balance should truly reflect everything you have in inventory. When we sell inventory, we're going to look back, and I'm sorry I can't go backwards, but we're going to say, what's our oldest inventory item? They were the 2,000 that cost $550 each. So we're going to remove 1,500 of those because this assumption is oldest inventory is sold first. So our cost of goods sold for this sale would be $82.50. What's left? 500 of the ones that cost $5.50, and then the 1,000 at $6 and 3,000 at $7. They're still here. When we purchase 3,000 more, add it to our existing inventory balance so it reflects all of our items in inventory. Then when we sell 3,000 of our cups, remove them oldest to newest. So we're going to go back to our prior inventory balance right before the sale, and we're going to say, what is our oldest inventory? We must remove 3,000 cups. Okay, 500 at $5.50. That's our oldest. Okay, so the first 500 we sold cost $5.50 each. Go to the next, 1,000 at $6. So the next 1,000 we sold cost us $6 each. We still have to account for 1,500 cups we sold. Oh, okay. Well, we had a purchase of 3,000. So 1,500 of the cups that were sold cost $7 each. So we remove them oldest to newest. So cost of goods sold for this sale would be $19,250. What's remaining? Well, of the 3,000 that cost $7 each, 1,500 are still in inventory, and then we still have the 3,000 at $7.50. So the inventory T account balance will have a balance of $33,000, and our cost of goods sold account would have a balance of $38,500. And that would automatically happen because your journal entries would be posted to those accounts. That's FIFO. And if you're sitting there saying, how do you know they're sold that way? We don't. We pretend. And it's okay to pretend. The last method is last in, first out. Last in, first out assumes the newest items in inventory, or the last ones purchased, are sold first. So we're first going to take you through the periodic system and how you would remove inventory under LIFO. Then we'll look at the perpetual. So again, under the periodic system, you're waiting till the end of the year to make one big journal entry. So what you do is you keep track of your beginning inventory and all your purchases for the year. So you know everything that you could have sold. At the end of the year, you go, okay, we sold 6,500. All right. Remove them newest to oldest. So we're going the opposite route of FIFO. Take a look. We're going to say the first 3,000 we sold cost $7.50 each. The next 3,000 cost $7. The next 500 cost $6. So under LIFO, cost of goods sold is $46,500. Then 500 costs $6 in inventory, and those 4,000, they're still in inventory at $5.50 each. And if you're going, how do you know that they're still in inventory? We're pretending, and it's okay. It's okay to remove them this way. Actually, this is a method that was created by Congress for taxes, and the FASB decided to adopt it since companies were starting to use it. It's just a way of expensing your inventory. We do not have to follow the actual physical flow of inventory out of our store. So even if you know everybody buys the first items you bought first, you could still use this method. So at the end of the year, if you use the periodic system and you remove inventory according to LIFO, you would debit ending inventory or inventory 25,000, credit inventory 22,000, the beginning inventory amount, debit cost of goods sold 46,500, and then credit for the purchase amount. I think it was 49,500. Okay, so take a look at that journal entry and you'll see that. Now, under the perpetual system, you're constantly removing inventory as you sell it. So it's a little different approach, kind of like what we saw with FIFO-Perpetual. So we start the beginning of the year with 4,000 units that cost $5.50 each. We sell 2,000 immediately on January 10th. Well, the only inventory items are those 4,000. So we remove 2,000 at $5.50 each. We have 2,000 remaining that cost $5.50 each. When we purchase 1,000 more, we add them to our existing inventory layer. Before the purchase, we had 2,000 that cost $5.50 each. We just, added another 1,000 that cost $6. We do that with the next purchase so that we could see all of our inventory balance in one area. After this purchase, here's what we have. Listing oldest to newest. Now remember that, because we're going to flip to the next slide where we're going to sell some of that inventory. When we sell 1,500, we go back and we say, what was the newest item in inventory? Oh, the ones we just bought that cost $7. Remove 1,500 of those. So the last purchase was 3,000 at $7 each. Under this method, we remove 1,500 of those. So the cost of goods sold would be 10,500 here. What's left afterwards? The 2,000 in beginning inventory are still here. The 1,000 we bought that cost $6, and only 1,500 of the ones we bought that cost $7. Now we add 3,000 more, new purchase. So you can see we have 4 layers now. The 3 that we were with just a few seconds ago, and then another purchase. Now watch what happens. When we sell 3,000 cups on November 20th, we go back and we say, what's our newest inventory? The ones we just bought at $7.50. We assume we sold those. And so cost of goods sold for that sale would be $22,500. After this sale, what's left? The 2,000 from beginning inventory at $5.50 each, the 1,000 from that first purchase we had during the year, and the 1,500 at $7. And I know I would sit there and go, how could that be? It's not saying that's what's actually happening. We're just assuming or pretending that happens, and it's okay. So under LIFO-Perpetual, your balance in inventory, because you've been removing inventory as you sold it, should be $27,500, and your balance in cost of goods sold should be $44,000. And when I say you've been removing it, you've been making journal entries for cost of goods sold and inventory after each sale. Periodic, we wait till the end and make one big one. So which method do you use? If you have a choice, if you should use specific identification if you can. But what if you can't? Well, a lot of it is based on your financial objective of your company. Take a look. If you use average cost, okay, cost of goods sold is $42,250. Given the same information, the same purchases, the same sales. Because we used that first illustration in that very first slide to demonstrate all the methods. Under FIFO, your cost of goods sold is $38,500, much lower. And under LIFO, it's one of the highest, $46,500. Now what they're demonstrating in this slide is that if you add your ending inventory to cost of goods sold under any of the methods, you still pay the same amount of money for all your inventory. $71,500. It's just the way you expense it is different. So you're going to have different expense amounts, cost of goods sold amounts under each method, and that's okay. So companies, well, in a time of rising prices, FIFO is the method that will give you the lowest expense, and that's the norm, rising costs. Costs usually don't decline. They usually go up. FIFO gives you the lowest expense, so the highest profit. So companies who want to show the most in net income, like FIFO. Companies that prefer paying the lowest in taxes use LIFO because they have the highest expense. And companies who want a little bit of both will use average cost. By the way, FIFO is used, I could just give you an example. Walmart International uses FIFO. Walmart Domestic uses LIFO. Domestic meaning the United States, because I don't think I told you, but we're the only country in the world that uses LIFO. Everybody else uses average, FIFO, or specific identification. Now, in a period of declining costs, so your inventory cost declines over time instead of going up, FIFO will give you a higher cost of goods sold. Okay? So you got to be careful of that. When it comes to the method you pick, you must identify which one you're using in your notes to your financial statements. So here's some information about some companies. A lot of companies use FIFO, almost 50% of them. The rest is pretty much split between LIFO and average costs or specific identification. So let's do a concept check right now. Fulbright Corporation uses the periodic. Remember, the periodic, you're making one big journal entry to remove all your inventory at the end of the year that was sold. During its first year of operations, here's some information about their purchases. They tell us their sales of how many units they sold. We want to know what is the ending inventory cost if we used FIFO. A deer just ran through my backyard. Okay, so 160 units are the first purchase. So if you make a little chart, you could go 160 times 50, 3 columns, 8,000, right? Then 280 would be your quantity for your next column, 40, multiply it out, 11,200. Then 680 could be your first column for quantity times unit cost, second column of 30, total cost 20,400. All right. Then you could say, okay, add up your quantities. 160 plus 280 plus 680. How many items could you have sold? 1,120. All right. It says we sold 1,080. So if you subtract 1,080 from 1,120, there's 40 left. So we need to distribute the total cost we came up with of all of our purchases between the number we sold and the number still on hand. It tells us they use FIFO. Okay, so what we can do is on your little chart there, you have quantity. I'm going to grab a piece of paper and do it myself. Quantity, unit cost, total cost. Let me just jot these down again. 160 at 50, 280 at 40, and 680 at 30. Okay, under FIFO, we sell the oldest items first. So the first 160 sold. They're gone. They'll be part of cost of goods sold. 280, they're sold. We sold a total of 1,080. So far, we've only accounted for 440 of them. Okay. Of the 680 that cost 30, 640 of them were sold. So the 40 remaining inventory items cost $30 each. And because that's what we're looking for here, ending inventory. If we were looking for cost of goods sold, we would have calculated each that were sold. So $1,200 is your answer. What if given that same information, we use LIFO? Well, if you set up your table again, 160 at 50 and your total cost, 280 at 40, 680 at 30. Now, what do we say here? The newest items are sold first. So 680 would have been sold, gone. 280 would have been sold, gone. We sold a total of 1,080 units. Of the 160 that were from our first purchase, 120 of them would have been sold. That would have accounted for the total quantity sold of 1,080. We're not trying to find out how much those had cost us. We're trying to figure out how much the remaining 40 cost us. So the remaining 40 cost $50 each. Now take a look here. This is a time of decreasing prices, right? So that's very interesting. And that's what we were talking about in that prior slide. So inventory cost would be $2,000. All right. So again, that was just a quick practice. Practice those for each method, periodic and perpetual, remembering what the periodic system is doing and the perpetual. Now, what this slide is trying to tell us is that we pick different accounting methods because of an objective we have. And it could be, and it's usually a financial objective of the company. So we have a choice on how we remove inventory, average cost, FIFO or LIFO. We have a choice on a depreciation method, straight line, double declining balance, units of production. There's even pension assumptions, which you'll learn about in Intermediate Accounting 3. So it's usually the item or method picked is because we're trying to achieve a particular financial objective. Again here, companies often attempt to sell the oldest goods in inventory first. That's our physical flow. So FIFO best suits the physical flow in these situations. If inventory sold comes from a mixture of goods acquired at various times, the average cost method may be more closely correspond to the actual physical flow. If there are very few inventories, that flow in a LIFO manner. The only one, like I think off the top of my head, are perishable goods. Milk. Don't we all try to buy the newest milk first? Okay. But it is not mandatory, and I've been trying to stress this, that you choose the method that approximates actual physical flow. No, because you could pick because of your own financial objective. If the unit of inventory changes, the method chosen will have an impact on the amount of income reported to external parties, the amount of taxes paid. So when inventory costs are rising and inventory quantities are not decreasing, LIFO produces the highest expense and the lowest taxes. Many companies choose LIFO in order to do that, reduce income taxes. The IRS requires companies to follow what we call LIFO conformity rule. And that says if a company uses LIFO to measure taxable income, which is for their tax return, it must use it for their financial statements. So which is not a factor that motivates companies to choose one method over the other? D, to make it easier for managers to maximize their own personal benefits. No. Okay, so now LIFO reserves. What is this? LIFO reserve is reported as a contra account. What it does is it adjusts the balance of inventory from whatever method the company uses during the year to a LIFO method for external purposes. So maybe a company says, well, we don't want to remove oldest to newest when we're actually selling it through the year. Let's use a LIFO or a FIFO or average cost method. What they'll do at the end of the year, recalculate inventory assuming a LIFO method, just so that they could report it on their financial statements. So they'll need to essentially debit or credit inventory to get the inventory balance from its current balance using the method they used during the year to a LIFO inventory balance. Instead of debiting or crediting the inventory account directly, they use a contra account to account for that difference and to either increase inventory to a LIFO balance or decrease it. And then the offset would be cost of goods sold. The reasons to maintain internal records other than LIFO, it's a lot of money to maintain records using LIFO. There might be a contractual agreement such as a bonus or profit sharing plan that calculates net income with a method other than LIFO. And using FIFO or average cost information is more reliable for pricing decisions about how much you should charge for your inventory. So here's a journal entry. Doubletree Corporation began 2021 with a balance of $475,000 in its LIFO reserve account. So that would be a credit balance. This balance means that the beginning inventory balance under LIFO is $475,000 lower than it would be under FIFO. Remember, it's a contra to inventory. By the end of 2021, assume the difference between the LIFO and FIFO inventory balance is then $435,000. That means our LIFO reserve must have a balance in it by the end of the current year of $535,000. Well, it currently has $475,000. So the difference will be debited to cost of goods sold, credited to the LIFO reserve. So we don't want to credit the LIFO reserve for $535,000. We just want to get it increased so that the total amount that will decrease inventory $535,000. So that's the amount of the journal entry for this year. Here's another illustration from McKeeson taking a look at their notes to their financial statements. And that's a disclosure you would have to make. LIFO liquidation. Now this is the final part of our chapter. LIFO liquidation means the last units purchased are assumed to be sold first, right? So the purpose of LIFO is to expense the highest cost items first. It's just the purpose of it, so you have the highest amount of expense. Well, in some periods, the number of units sold will be greater than the number of units purchased. So what does this mean? In these instances, inventory that's older, that has lower costs, are now going to be expensed. So you're not getting a true effect of LIFO then, because you're starting to expense really old costs. This is known as LIFO liquidation. So it results in old costs being matched with current selling prices, which defeats the purpose of LIFO. Take a look. National Distributors uses LIFO inventory. The company began the year with 20,000 cups that cost $16 each. During the year, they purchased 30,000 that cost $20. Okay, so they could have sold 50,000. To truly get the effect of LIFO, they should have only sold 30,000. Well, they're not going to say, oh, no, we can't only sell 30,000. No, they're going to sell as many as they can. But the impact is that they're not getting the true outcome of LIFO as it's intended to be, because they're going to be removing 30,000 of that very new cost, but then they have to remove 15,000 of that old cost from maybe last year or the prior year, because that's the cost that's still in inventory, defeating the purpose of giving you the highest expense. You could run through this one. I'm going to keep moving. Your answer there is B. If you have any questions, let me know. Okay, so keep that LIFO liquidation thing in mind. That could occur, and that's a bad thing for those who use LIFO. But there is a remedy. We're going to talk about it in a few seconds. Inventory levels are closely monitored to make sure inventories sustain operations and hold the cost of ordering and carrying inventories to the lowest possible level. There's some conflicts. Companies must maintain a sufficient quantity of inventory to meet customer demand. Inventory is costly, and if it's not being sold, it's a waste of money. It's not earning anything. So tools used to balance these conflicting objectives are, of course, computerized inventory control systems. We want to make sure we're only ordering when we need to. Maybe outsourcing our inventory component to someone else to manage, or using what we call just-in-time inventory systems. Now, just-in-time says we're just ordering the inventory in time to get it to the customer. So Dell uses a just-in-time inventory system. So when they don't make computers and let them sitting around, they take a customer order and they have such good relationships with their suppliers. They order the items, the inventory needed to make that computer then. And that the time to get it from the supplier to Dell is very small. It might be hours or day. And then Dell doesn't have a whole bunch of inventory sitting around. They order it when they need it. It gets to them. They make the product and immediately sell it. That's just in time. It's relatively low inventory balances are maintained and customer demand is quickly met. So if companies have that great relationship with their suppliers and suppliers can provide them with their items so they can make their product and get it out to their customers, these are the systems we want to use. Harley-Davidson is another example. Company known for its custom-ordered motorcycles. Many of the components used in production are acquired when the order is placed. Great. Some other items before we get into this LIFO and how we remedy these LIFO liquidations. Important ratios companies use to determine how well they are doing with pricing and managing their inventory. Gross profit ratio, which takes gross profit, net sales minus cost of goods sold, divided by net sales. Tells you our percentage of profit on our sales. Inventory turnover, that tells us how many times we sell our inventory during the year. That's found by taking cost of goods sold divided by your average inventory. Average inventory is usually calculated by taking beginning inventory plus ending inventory divided by 2. So the higher the ratio, the more effectively a company manages its inventory. So what's important to remember though is every industry is different. Some inventory items also will sell quicker than others. So this is an average overall. So for instance, during the year, Hendricks Chemical Company reported sales of $3.5 million, cost of goods sold of $1.4 million, and net income of $140. The company's gross profit ratio is, well, net income has nothing to do with our calculation. We're going to take the 3.5 minus 1.4 to get 2.1. 2.1 divided by 3.5 is 60%. Gross profit is 3.5 sales minus cost of goods sold, and divide that by 3.5, our sales. So 60% of our sales remains as profit after paying for our inventory, cost of goods sold. An inventory turnover quick example, Grainger Clothing has the following on their financial statements. We take beginning inventory plus ending inventory, divide by 2, that'll be 210. Divide the 210 into 630,000. And your answer is 3, and there it is. 630,000 cost of goods sold divided by average inventory. So they sell on average their inventory out 3 times per year. Now, is that good or bad? They're going to look at their past history. They're going to look at their peers in their industry to see what they do. Okay, our final area, simplifying LIFO. Okay, so the limitations of LIFO, record-keeping costs are very significant. When a company has numerous individual units of inventory, like Walmart, think of that, and they use LIFO. When unit costs change often during a period, okay, the probability of LIFO inventory layers being liquidated. Whoa, what's that? Let's take a look. A LIFO inventory pool says this. Let's group inventory units into pools based on their physical similarities. So maybe all the toilet paper is in its own pool. Within pools, all purchases during a period are considered to have been made at the same time and at the same cost. Individual unit costs are converted to an average cost for the pool, and this is allowed. If the quantity of ending inventory for the pool increases, ending inventory equals beginning inventory plus our single layer added during the period at the average cost of the pool. So what does this mean? Beginning inventory costs are always there, okay? And the additional inventory that's added during the year, because remember, the oldest goods are still in inventory, okay? They will still be here at an average cost instead of higher cost, lower cost, whatever. We're trying to fight the impact of LIFO liquidation here. Take a look. Diamond Lumber Company has a rough cut lumber inventory pool that includes pine, oak, and maple. The beginning inventory consists of the following. So they aren't accounted for each individually. They're put into this pool. There's 40,000 in this pool, cost 98,800. The average cost for the pool is $2.47 per board foot. During the next reporting period, they purchased 50,000 board feet of lumber. Diamond sold 46,000 board feet during this period. Okay, so now their new average cost for these purchases, $254. Because that's what they're showing you. Now watch what happens. What did they sell? They sold whatever number. They have 44,000 board units still left in inventory. Under LIFO inventory pools, we say the first 40,000 cost $247. The next 4,000, because we're adding inventory here, costs $254. The average cost. And if you're going, well, remember, what would you have done? You would have removed all the inventory to this point because the newest items are sold first. These are the only things usually left at the end. Instead of using the actual cost for those 4,000 and maybe, having a problem with LIFO liquidation or just being too complex to figure out, just average those pools together and use an average cost per pool. And it simplifies your LIFO. Finally, dollar value LIFO is an inventory pool, is viewed as comprising of layers of dollar value from different years. The pool is made up of items that are likely to face the same cost change pressure, so they may increase together or decrease together. The inventory is viewed as a quantity of value. So it's not looked at as physical quantity, but dollar quantity. Companies are allowed to combine a large variety of goods into one pool. Now, we're not going to show you how to create a pool. Every company does it a little differently, but we're going to show you how to calculate what is this dollar value LIFO and how it stops LIFO liquidation, or not stops, but lowers the impact of LIFO liquidation on LIFO. Take a look. First of all, the first thing we need to calculate is a cost index each year. What does that mean? We take the cost of our inventory in this year, in a layer year, and divide it by the cost in a base year. So that'll tell us how much cost or prices have increased from the base year through this year. The objective of this is to deflate inventory amounts by increase in prices. So let's take a look. Here's our three-step process. Here's what you do. You are still going to account for your inventory however you do it, LIFO, FIFO, average cost. What we do is, especially if you're going to get it into a LIFO amount. We're going to convert your LIFO ending inventory as if it was your ending inventory in your base year. So now we can compare this year's ending inventory to our base year to see, did we have more inventory added, or was the inventory higher because prices went up? We'll show you this. It's kind of weird right now. Then we're going to identify layers of ending inventory that we create each year. And then we're going to restate each layer using the cost index for that year. Take a look. Haynes Company adopted dollar value LIFO method on January 1, 2021, when the inventory cost was $400,000. That is their base year, $400,000. So their inventory costs will always be at $400,000. Remember the objective of LIFO. You'll have the lowest ending inventory amount under the three methods using LIFO. 2021 ending inventory in the ending inventory account was $462,000. So if we just put that on our financial statement, we would say, well, we have inventory of 462,000. Dollar value LIFO says, make sure you're really getting the true benefit of LIFO. Go through this system. It says first, determine what your cost index was for the year. How much do prices generally rise over the year? 1.05%. So they're 105% of the amount they were at the beginning of the year. Okay, divide the end of year inventory balance by that 1.05. Essentially what you're doing is restating the inventory at January 1 costs. Okay, so what we're saying is if you bought that inventory and how much it cost on January 1, it would have only cost you $440,000. So your inventory at base year costs really is comprised of the $400,000 it started at the beginning of the year plus $40,000 additional amount of quantity you added, because only $40,000 was increased by quantity. It had nothing to do with cost increasing. Why? Because you've already taken out the cost increase by dividing that $462,000 by 5%. Okay, so your ending inventory increased quantity-wise $40,000. Next, $400,000 is going to be cost at 100% your base year. That $40,000 additional layer is the additional quantity you put in at current year cost, 1.05. So multiply the 40,000 times 1.05, add that to the 400,000. So under dollar value LIFO, you truly get the lowest ending inventory amount, 442. Remember what it was, 462? If you didn't do dollar value LIFO, your inventory would have been $20,000 more than it needed to be. Your cost of goods sold would have been $20,000 less than it should have been. That's not the objective of LIFO. The LIFO objective is highest cost of goods sold, lowest inventory. On December 31st, 2021, Burroughs adopted the dollar value LIFO. Inventory at the end of the year was 600. At the end of 2022, it was 806.40, 400, and the cost index is 1.05. Follow those same steps. So when you're trying to determine the dollar value LIFO cost of your ending inventory at 2022, first step, take what it currently is at, 806,400, divide it by the 1.05, so you pull out any increase in pricing out of that number. So if you bought that inventory at the beginning of the year, it would have been $768,000. Okay? So the first $600,000 of that is valued at 100% cost. The next $168,000 is valued at 1.05. So if we add the 176,400 plus the 600,000 under dollar value LIFO, your inventory should have been 776,400. So only the part of your inventory that increases this year at base year cost should be valued at current year costs. And that's what step 2 does. I know it's a little funky, but you got to stop and think about it. The advantages of this, it's actually simple to keep your records. It minimizes the effects of LIFO liquidation because you are truly finding a better number based on dollar value. And finally, international accounting, you can take a read through that. And that's the end. I think we had enough in this chapter, huh? So great information. Please post your questions about dollar value LIFO. I know it's a funky thing, but remember, what are you trying to achieve? You're trying to find the lowest inventory amount and the highest cost of goods sold. That's the objective of LIFO. And dollar value LIFO helps you achieve that by using those 3 steps.